Welcome, my friends. The news today is that mortgage rates are racing toward 8% after hitting a high not seen since late 2000. The average rate on the popular 30-year fixed mortgage rose to 7.72%, according to Mortgage News Daily. Mortgage rates follow loosely the yield on the 10-year Treasury, which has been climbing this week. What does it mean for the economy? And, what does it mean for the future of the United States? But, before we get into all of that, please press the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. And, before we continue, a word from the sponsor of this video. Today's sponsor is ProWorldNet.com. ProWorldNet.com is a job website specifically dedicated to licensed professions. Doctors, including any type of specialty. Nurses, and that includes all grades of nurses. Lawyers, regardless of area of legal focus. Teachers and professors, from kindergarten through graduate school. As well as any kind of job that requires a government license or certification. And ProWorld.net also includes short-term gig-type jobs as well. So, be sure to check out ProWorldNet.com if you are looking for a job or an employee. The average rate on the popular 30-year fixed mortgage rose to 7.72% on Tuesday, according to Mortgage News Daily. Mortgage rates follow loosely the yield on the 10-year Treasury, which has been climbing this week following strong economic data. Rates have not been this high since the end of 2000. At the beginning of this year, the 30-year fixed rate dropped to around 6%, causing a brief burst of activity in the spring housing market. But it began rising steadily again over the summer, causing sales to drop, despite strong demand. The current trend appears to be even higher, with the possibility of rates crossing over 8%. The Federal Reserve did not raise interest rates 2 weeks ago but indicated the possibility of another hike this year and fewer cuts than expected next year. Investors were waiting to see the results of economic data in the first week of October. It is now the first week of October, and data has been stronger, wrote Matthew Graham, Chief Operating Officer at Mortgage News Daily. This morning's JOLTS, Job Openings and Labor Turnover Survey, is the biggest, baddest confirmation so far this week, and it's pushing yields to fresh long-term highs. Pretty simple stuff, actually, even if unpleasant and unfortunate for fans of low rates. Higher rates have crushed affordability, hitting both the new and existing home sales markets. While builders had been benefiting from the tight supply of existing homes for sale, higher mortgage rates are a major concern now. Builder sentiment slipped into negative territory in September for the first time in 5 months. To put rates in perspective, for a borrower purchasing a $400,000 home with a 20% down payment on a 30-year fixed loan, the monthly payment today is about $930 more than it was when rates were at 3% during the height of the pandemic. Even though mortgage rates have already reached their highest point in 20+ years, there's a chance they could climb even higher, even as high as 8%. It all depends on how the Federal Reserve decides to tackle stubborn inflation in the next few months, economists told CBS Money Watch. Fed officials said they believe high inflation is still enough of a threat to the U.S. economy to possibly warrant additional interest rate increases to help combat the issue, according to minutes released this week from their July policy meeting. Should the Fed decide to raise rates again at its next meeting in September, it would be the 12th in 18 months and could mean even higher costs for homebuyers. Mortgage rates don't necessarily mirror the Fed's rate increases, but tend to track the yield on the 10-year Treasury note. Investors' expectations for future inflation, global demand for U.S. Treasuries and what the Fed does with interest rates can influence rates on home loans. Higher mortgage rates can add hundreds of dollars a month in costs for borrowers, limiting how much they can afford in a market already deemed unaffordable to many Americans. And, what about historical mortgage rates? A recent survey from Bankrate found that 1/3 of respondents who aspire to buy a home say high mortgage rates are holding them back. But in past decades, homebuyers faced even steeper loan rates. High rates are challenging for homebuyers, but it's worth noting that Americans bought homes before the recent era of super low rates, said Jeff Ostrovsky, a Bankrate analyst. In one off-cited example, mortgage rates went as high as 18% in the early 1980s, and buyers still found ways to get deals done. Why are mortgage rates so high? If the Fed raises rates again, mortgage lenders will likely respond by either raising their rates or keeping them closer to today's roughly 7.2%, economists said. The Fed's regime of interest rate hikes began in March 2022 as a way to cool the hottest inflation in 4 decades, as consumers and businesses tend to cut back on buying homes and other purchases when borrowing costs are higher. If the 30-year fixed mortgage rate can hold at a high mark of 7.2%, and the 10-year yield holds at 4.2%, then this would be the high for mortgage rates before retreating, said Lawrence Yun, chief economist at the National Association of Realtors, NAR. If it breaks this line and easily goes above 7.2%, then the mortgage rate could reach 8%. An average 8% on home loans would be sour news for homebuyers, many of whom already faced a challenging market this summer with fewer homes available and higher asking prices. The national median home price hit $402,600 in July, up from $359,000 at the start of 2023, and the typical mortgage on a single-family home is now $2,051 compared with $1,837 a year ago, according to NAR. Yun said 8% mortgage rates would bring the housing market to a halt and may even sink asking prices. Credit card companies are racking up losses at the fastest pace in almost 30 years, outside of the Great Financial Crisis, according to Goldman Sachs. Credit card losses bottomed in September 2021, and while initial increases were likely reversals from stimulus, they have been rapidly rising since the first quarter of 2022. Since that time, it's an increasing rate of losses only seen in recent history during the recession of 2008. It is far from over, the firm predicts. Losses currently stand at 3.63%, up 1.5 percentage points from the bottom, and investment bank Goldman Sachs sees them rising another 1.3 percentage points to 4.93%. This comes at a time when Americans owe more than $1 trillion on credit cards, a record high, according to the Federal Reserve Bank of New York. We think delinquencies could continue to underperform seasonality through the middle of next year and don't see losses peaking until late 2024, early 2025 for most issuers, analyst Ryan Nash wrote in a note Friday. What is unusual is that the losses are accelerating outside of an economic downturn, he pointed out. Of the past 5 credit card loss cycles, 3 were characterized by recessions, he said. The 2 that occurred when the economy was not in a recession were in the mid-90s and 2015s to 2019, Nash said. He used history as a guide to determine further losses. In our view, this cycle resembles the characteristics of what was experienced in the late 1990s and somewhat similar to the 15 to 19 cycle where losses increase following a period of strong loan growth and has seen similar pace of normalization thus far this cycle, Nash said. History also shows that losses tend to peak 6 to 8 quarters after loan growth peaks, he said. That implies the credit normalization cycle is only at its halfway point, hence the late 2024, early 2025 prediction, he said. Credit card debt is still a big problem even though the Fed didn't hike interest rates. Americans with credit card debt won't see any relief even after the Federal Reserve decided against hiking its benchmark rate on Wednesday. Their situation just won't get worse, for now. Fed policymakers kept the range for the federal funds rate unchanged at a 22-year high between 5.25% and 5.5%. But Fed Chair Jerome Powell indicated that the majority of officials expect at least one more quarter-point hike before the end of the year. That means credit card interest rates, which march in sync with the central bank's rate, could increase before the year end. At the very least, they will remain near 4-decade highs for the foreseeable future, troubling news for folks who have piled on debt. Even though the Fed chose not to raise rates in September, the truth is that no one should expect credit card interest rates to stop rising anytime soon. Matt Schultz, credit industry analyst for LendingTree, said, "While we don't know what the Fed will do going forward, cardholders' best move is to assume that rates will continue to rise and do what they can to knock their credit card debt. It's certainly easier said than done when life is so expensive in 2023, but it should be the goal," he added. Outstanding credit card balances topped $1 trillion this year for the first time ever, with borrowers undeterred by interest rates that are at their highest level in nearly 40 years. According to Bankrate, the average APR this week was 20.71%. Store credit cards have even higher rates, separate data from LendingTree found, with APRs averaging 30% or higher. The truth is that today's credit card rates are the highest they've been in decades, and they're almost certainly going to keep creeping higher in the next few months, Schultz said. For someone shouldering credit card debt, elevated interest rates can make it harder to pay off balances quickly. Instead, those paying just the minimum could see their balances balloon. There are also recent signs that cardholders are struggling more with their debt. The delinquency rate on credit cards reached 2.77% in the second quarter of 2023, according to the Fed, the highest level since 2012 when it was 2.82%. Last month, over half of credit card borrowers, 51%, couldn't pay off their entire balance each month and let the debt roll over from one month to the next, accruing interest, a separate study from J.D. Power found. That was the first time the share of Americans revolving their debts was higher than the portion who paid their bill in full. More than 3/4 of cardholders who asked for a lower APR for their credit card in the past year received one, according to an April 2023 report by LendingTree. Folks who asked got at least 6 percentage points off their April. The fact that card issuers are still willing to give breaks like that, even in the wake of a year of frequent rate hikes, is great news for cardholders, Schultz said. However you slice it, it is well worth your time to make a call. According to Schultz, borrowers may also benefit from transferring their debt to a 0% balance transfer card. They are still available and people with good credit standing can get up to 21 months with zero interest. Those that can, could also consider opening a high-yield savings account, which have also benefited from Fed hikes. But, what do you think? Please leave us a comment below and hit the like button. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. Thank you for watching.